Every month, thousands of people in India are paying 3,000 to 15,000 rupees for the chance to trade someone else's money. Funded accounts and Forex prop trading firms under multiple brands and names are getting very popular nowadays. The requirements are very easy. Walk in with no capital, pay a small entry fee, pass a test and get a big 40 lakh rupees account to trade with and keep 80% of the profits for yourself. On paper, it sounds like the most obvious thing a smart, ambitious trader should do. But here is what nobody is telling you. 99% of traders who buy these trading challenges walk away with nothing. Not because they're bad traders, but because the entire model is engineered in that way. So in this video, if you have never heard about the concept, first we'll break down exactly what is prop firm funded account trading and how it works, why their business model is designed to work against you, and what you need to know before you spend a single rupee on such a challenge. So if that's the case, what are you waiting for? This is Ajay Ajith. Welcome to a market feed video. First, let's look at the facts around us. The entire reason that this Forex prop firm industry exists and why it is specifically taken off in India. Most aspiring traders don't have 50 lakh or 1 crore rupees just sitting around to trade with. Prop firms solve that problem, or at least they appear to have solved it. Pay a small fee, pass a test, and someone hands you a 40 to 50 lakh account to trade with. That's why globally and in India, the search volumes for prop firm has gone up by more than 100x in the last 5 years. For a 25-year-old in Bangalore or Chennai with trading ambitions and no capital, this pitch is almost impossible to ignore. But is it actually true or is it a scam? Is the video. So let's quickly understand how this industry works. And for that, we need to first look at what is Forex trading. The Forex trading market is the largest financial market in the world. Over $7 trillion is traded every single day in that market. To put that into perspective, the entire NSE's daily equity turnover is just a fraction of what moves through the Forex market in just 1 hour. How it works at a basic level, let's discuss that. You're always trading one currency against the other. In an example, you would be trading euro against the USD. That means you're buying euros and selling dollars or vice versa. In this pair, the prices move based on a lot of factors: interest rates, inflation, geopolitical events, and as always, market sentiments. The people who participate in the Forex market are not always retailers. Retailers are just a small part of this market. Central banks, multinational corporations, hedge funds, large commercial banks, they are the major traders here, and retailers form just a small part of the pie. Now that is just a very simple explanation of what Forex trading is. I've made a detailed video on this concept. If you want to learn more about it, I'll be putting that up in the I button right here. Before we go ahead, for us Indian traders, we should understand that not all Forex trading is the same. There are two very different, distinct ways where people trade Forex. One is legal in India, the other is not. The first one, exchange traded currency derivatives. It is legal in India, technically, but it is less popular. I'll tell you why. The second method is CFD based Forex trading. This is what the majority of Forex trading influencers, prop firms and trading platforms are actually selling today in India. And this is where the legal and structural problems begin. We will understand both in detail quickly in the next section. Exchange traded currency derivatives is Forex trading done on regulated Indian exchanges: NSE, BSE and MSE. These are all regulated by SEBI and they are governed by the FEMA rule. Here, only 4 INR paired currency contracts are allowed: USD INR, Euro INR, GBP, Great Britain Pound INR and the Japanese Yen and INR. Trades happen on a transparent exchange with a regulatory body. There is a grievance redressal mechanism and there is legal protection. However, this is the most critical update. As of May 2024, even this has been effectively shut down for retail traders. The RBI issued a circular in January 2024 mandating that currency derivatives can only be used for hedging contracted exposure. Meaning, if you're an exporter who needs to protect against rupee fluctuation, you can trade in this Forex pairs. But if you're a retail trader trying to make money from currency movements, you cannot trade it. When this rule came into picture, the daily turnover of NSE's currency segment dropped from $3.7 billion in March 2024 to under $800 million by the late 2025. Bottom line, as of today, there is no legal route for a retail trader in India to speculate on currency markets domestically. But even though the law clearly says it is illegal, let's learn a bit about the second method also, which is a CFD-based method. Trading CFD stands for contract for difference. The name itself tells you what it is. You're entering a contract where the settlement is done between the price where you open the trade and the price where you close it. You never own an underlying asset here. If you trade the Euro USD on a CFD platform, you do not own any euros. You're simply speculating on whether the price will go up or whether it will go down. The first method used to offer roughly 10 to 20x leverage, but CFDs offer up to 100x. CFD trading through overseas brokers is illegal in India under the FEMA, the Foreign Exchange Management Act. It does not permit Indian residents to remit money abroad for speculative trading purposes, thereby making CFD completely illegal. Then how are all of these prop trading platforms running a lot of ads on social media? That's what we'll understand now. There are two ways a retail trader can access CFD Forex trading. The first is by directly opening a personal trading account with an overseas CFD broker. Again, this is straightforwardly illegal in India under FEMA, no grey area, no confusion. But the second way is through a prop firm funded account model, which comes under a grey area. So let's learn about what is a prop firm and how does a funded account concept work in the next section. A prop firm is a company that provides capital to traders in exchange for a profit split. Traditional prop firms hired traders as employees, trained them, gave them a salary and put firm capital behind them. In the traditional model, the firm had strong incentives to select and develop the right people because they were paying salaries regardless of performance. You can find this method and model even working today in large multinational banks. They hire well-educated employees, train them, give them capital and ask them to generate profits on top of it. But the modern online prop firm model that has exploded since 2020 works in the completely opposite direction. You have to pay them first. You prove yourself through a paid evaluation. Only if you pass do you get access to capital. Let's look at how a funded account works step by step. Pay a challenge fee. Pass phase 1 where you have to hit a profit target and stay with it in the drawdown limit. Then pass phase 2 where the same logic is applied but with different targets. After this, you will be getting a funded account, typically $10,000, $25,000, $50,000 or even $200,000. Here, you can trade and split the profits, typically in a 80-20% in your favor. You get to keep 80% of the profits. I'll show you an example screenshot of different challenges of a popular funding prop firm in order for you to understand this concept better. So now you know how the challenge works. But here is a question you should be asking yourself. If they're giving out 40 lakh rupees accounts for 3,000, 4,000 rupees fee, how is this even a business? The answer is first in the pass rate. Only 5 to 10% of traders pass the evaluation on their first attempt, and only 7% of these challenge buyers across all attempts ever receive a payout. That means 93 out of 100 people who buy a challenge pay the fee and walk away with nothing. Let's put some real numbers behind this. Taking the most affordable challenge out there, a $5,000 account, you can trade it with a $36 entry fee. So let's say 100 people buy this challenge, that is $3,600 in the pocket of the firm. Here, only 7 people ever get funded. That means 7 into 5,000. $35,000 is a total capital now at risk for the funding firm. But the maximum those 7 people can ever cost the firm, according to the challenge rules, is a stop loss or a drawdown of 10%. That will come down to $3,500. Because the moment any account drops below 10% in losses, it gets shut down automatically. So let's look at the math behind it. The firm collected $3,600 minus $3,500 maximum possible exposure, maximum possible loss. Even with all of this, the firm is profitable even in the absolute worst case scenario, where every single funded trader loses a maximum allowed amount. And in reality, most funded traders breach their drawdown rules long before hitting the 10% limit. The typical outcome for the firm is far better. On top of this, if there are profitable traders, they still have to share a profit with the prop trading firm. It can vary from 0 to 40%. So the challenge fee model in itself covers the entire downside for these firms, and the profit split from winning traders is purely an additional upside. Then eventually, when you don't pass, you're not even. Your initial investment or the money that you give for the challenge is gone. But even after knowing all of this, still some traders prefer to try out this funded trading account mechanism. So for them, let's discuss or go into the next section, which is problems with this model. The first problem, in the case of a true prop firm, the firm wins only if you as a trader profit and win. In the case of these funded accounts, what I call as fake prop firms, they win when essentially you end up losing money, which goes against the original idea that they give you an account with real money for you to trade in. Second problem, let's say you are trading and you're watching some prices on TradingView or some other broker. You have set a target and a stop loss. You see the price coming near your target or stop loss, but then reversing quickly, it did not touch your level. But in your funded account, it would have already hit your stop loss. One thing to understand here is that these firms do not act in your interest. They are not unbiased. They are not legally registered brokers. They want you to lose. In fact, compare that to any other legal broker or even a prop firm across the world. That is the case. Ideally, they all want you to keep winning so that they can retain you as a paying customer for as long as possible. Since these funded accounts often run their own exchanges, they can manipulate prices in any way, and that is definitely a huge problem. Your probability of success is further reduced from there. Third problem, let's say you really do end up making a profit, but the most common method used by these Indian prop trading firms is crypto transactions. That means a firm sends you a payout in USDT directly to your crypto wallet. They mark it as salary and the money comes into your account from some random company. You can pay a 30% tax on this income, but it is a direct violation of the FEMA guidelines to use these platforms. That means if caught, the government would make your life a living hell, which I would say is never worth the risk. Think about it. You don't even know where the money is really coming from. What all sorts of illegal activities that money has been involved in. Do you want to get involved in all of those? Think about it really well. The fourth problem, there are some real case scenarios which I found out during my research where the profit sharing agreements have not been honored by these prop trading firms. In fact, I've seen instances where traders receive less payouts or even very delayed payouts. The fifth problem, they are not properly regulated or registered entities. Most of these companies that you see online will be registered in countries with very little legal challenges like Saint Vincent or Seychelles. There are no legal enforcements holding them accountable in those countries. Even in India, SEBI and RBI have clearly mandated that these platforms are illegal. So if there is any legal issue which comes up where they don't honor your payments or any other issue that may pop up, you will not be properly supported even by the Indian legal system. So then let's come to the last section of the video, which is, should you try out funded accounts? Hope you've already understood the answer from this entire video. But if you have not, my advice is very straightforward. Stay away from Forex trading, stay away from funded accounts. In this video, we have clearly understood what is Forex trading, what is a funded account, and exactly how it works. By giving you this knowledge, I hope that you'll be aligned to my advice, which is to not try any of it. Trading is a high value skill. Understanding chart patterns, understanding price movements of assets, and being able to make money on them, it is a crazy skill for you to have. If you're able to build or succeed in building that skill, then I believe there is nothing stopping you from finding capital to trade with. And if you're a good trader who can find capital yourself, then why do you need this funded account concept in the first place? That's my video. This is Ajay Ajith signing off. See you all. Bye bye.